Oil prices slide on extra production from OPEC. The Taiwan dollar surges, forcing central bank intervention. The Hong Kong Monetary Authority also intervenes to stop the Hong Kong dollar rising above its peg to the US dollar. And Indonesia is set to cut interest rates after soft GDP growth. It's coming up in our 5 Things in 5 Minutes on Tuesday, May the 6th. And then in our bonus deep dive interview, ANZ's chief economist for Southeast Asia and India, Sanjay Mathur, looks at whether a sharp sell-off in India's stock market is justified.
If someone is looking for a safe market with visible earnings streams, I think that there is a case for flows to come back to India and the Indian equity market to do well.
But first, in 5 and 5 with ANZ, the big news on financial markets in recent days has been an historic 10% rally in the new Taiwan dollar against the US dollar, as exporters brought home their dollars and Taiwanese pension funds repatriated assets back out of US markets. Here's ANZ's Head of Asia Research, Koon Go.
The appreciation just compounded with exporters getting a bit nervous and starting to convert their US dollar proceeds. And we suspect Taiwanese life insurance companies then further drove the rally in the Taiwan dollar when they started to cover their underhedged positions. And it all smells of panic activity on Monday following further moves. But all of these does look a little bit overdone in my view.
As of 4 a.m. Sydney Melbourne time, the Nasdaq and S&P 500 are down 0.2% after more Trump tariff news, this time a 100% tariff on movies made overseas. The US 10-year Treasury yield rose 4 basis points to 4.36%. The US dollar index is down 0.1%. The Aussie dollar up 0.3% at 64.64 US cents, while the Kiwi starts up 0.2% at 59.60 US cents. Gold up 2.6% at $3,328 US dollars an ounce, while West Texas futures are down 2% at $57.17 US a barrel after OPEC confirmed that higher output. Number 2. Koon says one reason for the historically sharp rise in the new Taiwan dollar, and therefore a fall in the US dollar to buying 29.16 Taiwan dollars, is exporters had been storing up their US dollar receipts overseas. Those stockpiles are coming home in a rush.
Taiwan continues to run very large trade surpluses, but the last few years, exporters have largely been keeping most of their export proceeds in US dollar, and they've been converting less and less of them into Taiwan dollar. Given expectations of further dollar weakness and comments that trade talks might be moving in the right direction, we probably started to see those exporters start to convert more of their accumulated foreign currency proceeds. And for the Taiwan life insurance companies, they hold large amounts of overseas assets, particularly US fixed income assets. And it's possible that they are starting to worry about potential for a weaker dollar and started to hedge in anticipation of that, which also added to buying pressure for the Taiwan dollar.
Number 3. Koon says the jump in the Taiwan dollar was so sharp the central bank had to intervene, and Taiwan's stock markets fell on fears about what a strong currency might mean for export earnings.
There is a worry that sharp strengthening in the Taiwan dollar within a short space of time will negatively impact on exporter margins in particular. And Taiwan is an economy that is heavily reliant on exports. So any sharp strengthening in the Taiwan dollar could negatively impact on exporter returns.
Number 4. There's also been drama in Hong Kong, with the monetary authority there forced to intervene on Friday and again yesterday to sell Hong Kong dollars for US dollars to stop the currency appreciating out of the peg.
And the size of the intervention last Friday was the largest on record. They were estimated to have bought roughly about $6 billion US dollars. Now, the intervention of this size will lead to an increase in the HKMA's aggregate balance, which will help to loosen liquidity conditions and help to lower borrowing costs.
Number 5. Indonesia's GDP growth rate softened in the March quarter to 4.87% from 5% in the December quarter, which Crystal Tan says is likely to continue into the rest of 2025, adding pressure on the central bank to ease policy.
The pullback has been led by domestic demand, and the weakness was broad-based. So we had government spending declining. That's in part due to budget reallocations and also a slow start to the government's priority program. Investment growth, that weakened as well. That came against a backdrop of heightened policy uncertainty both on the global and domestic fronts.
Crystal says the easing could come quite quickly.
We do think monetary policy easing is on the cards. Bank Indonesia has already extended its macroprudential incentives effective the 1st of April. So basically, banks that lend to priority sectors will now see their reserve requirement ratio lowered. So that's in the hopes of encouraging credit growth. Now, we do think policy rate cuts are a matter of time. We see scope for 325 basis point cuts this year. The next could possibly come as soon as this month.
Crystal Tan there. Now, in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, has analysed a 17% fall in India's stock market between September last year and March this year to find out if it's been overdone relative to its earnings, India's market history, and peers in the region. I asked Sanjay what caused the sell-off and how exposed India is to Trump's tariff shocks.
Interestingly, the sell-off in Indian equities really started around October of 2024. And the real reason for it was that high-frequency economic data had suddenly taken a turn for the worse. And since then, even the GDP numbers have been a bit of a hit or miss against consensus expectations. So there has been a downward recalibration of growth. This was largely independent of tariffs that came about much later. Now, India is exposed to the global economy and tariffs do matter. But the question for us is, if these tariffs were to be put in place, the April 2 announcements, India would probably lose a lot less than some of the other economies because it's much less exposed to global trade.
And is there a chance that India could do better relative to other economies in Asia? For example, if it does a trade deal with the United States and some manufacturers move some of their operations to India, as we're seeing with Apple?
Yeah, so I guess most likely the Indian economy will do better even with the tariffs staying in place. But the icing on the cake would be that India would be able to strike an early deal with the US on tariffs, and there are the sound bites in that direction are quite positive. Going forward, there is also a case where some of the manufacturing will shift to India. We cannot identify or determine the quantity of change, but we have been seeing some positive headlines around things like bulk of iPhone manufacturing would shift to India. So there is a case for India to advantage from the trade wars globally.
And what are you seeing with both domestic and foreign investors in their drawdown or addition to the Indian equity markets?
So between October 24 and March 25, we saw a very massive drawdown. In fact, the foreign drawdown was pretty much what we saw, or equivalent to what we saw during the initial phases of the Ukraine-Russia conflict. But since March or end of March, we started to see that flows have started to pick up again. And as a result, the equity market seems a lot stable than where we were just 3 months ago.
And one of the other interesting factors you've identified in one of your notes is the correlation between India's equity markets and US equity markets. What's going on there?
Traditionally, India's equity market correlation with the US, as well as the underlying volatility, has been quite high. The reason being that a lot of the funds that invest in India are foreign funds that invest in India domiciled in the US. So the relationship has generally been quite tight, even though the broader macroeconomic relationship has not been.
Do you think, therefore, given what's happened with Indian stock markets, that prices have gone down as far as they're going to? Or is there even a potential for a rebound as investors re-examine the current valuations?
I think there is a case for the rebound. As I said earlier, that India's GDP growth, the slower, is more certain to come through than the more open economies in the region. And to that extent, there is greater visibility over earnings. Second, if we sort of look at what is the share of revenues that listed Indian corporates derive from overseas, it's only about 30%. That's much, much lower than the EM average. So if someone is looking for a safe market with visible earnings streams, I think that there is a case for flows to come back to India and the Indian equity market to do well. And the important implication of that is that it is very favorable for the balance of payments and for the currency by implication.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 6th. Catch you tomorrow with a preview of New Zealand's jobs figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.